Hi, this is Alex Mozed, founder of Applico, co-author of Modern Monopolies, and we are here on Winner Take All, talking about all things tech, regulation, and modern monopolies. So we're going to dive in to talk about the London Stock Exchange, which is a platform, buying Refinitiv for $27 billion towards the end of last week. Bloomberg, not many people would think of Bloomberg as a platform. Well, it is, and you're going to learn why. Weibo, a popular Chinese content platform, has been having its run-ins with Justin Bieber, Robert Downey Jr., and some interesting developments on now Chinese social networks.
Come on, Biebs.
Google and their auction that they launched for default search browsers to comply with EU regulation. It's a funny twist that they put on how they're complying with that regulation. Gambling in the United States just got much more interesting with a new platform entrant into the US market. And eBay has sued Amazon over transgressions against their third-party sellers. And we're going to dig into that. And then lastly, is digital advertising a winner-take-all market, as we've seen more content platforms gain in advertising revenues? Are we starting to see a break in the stranglehold from Google and Facebook? Okay, so jumping on into the London Stock Exchange, and joined here with me is Nick Johnson, co-author with me on Modern Monopolies. So Refinitiv is a financial information company. They have all sorts of different data and financial data of the like. Were acquired by the London Stock Exchange for $27 billion. London Stock Exchange is in Plaid, in the Plaid ETF, and is a platform that has all different types of just trading platforms, right? Investment platforms. And what this looks like to me is the London Stock Exchange trying to go up and compete against Bloomberg, and to try and bring in this information and have a much more packaged sale than just having the trading environment and the investment platform, which is what they've had quite successfully for many years. What do you take of it, Nick?
I think it makes sense for them to try to compete with Bloomberg on the data side, but I think where the tough part is, Bloomberg is a platform where they make their money isn't just on the data, it's really on this network they've created, where you have all these traders basically on Bloomberg. They can connect directly to each other. The way I would kind of think of it is like a finance-wide Discord or Slack for finance professionals, and is basically layered on top of all this data. The data's part of it, to me, is less defensible. You have a lot of people that have basically unbundled certain parts of Bloomberg and particular data sets and basically offer it for much cheaper than the whole Bloomberg bundle. But the value right now is really in that network that Bloomberg gives you access to, all the other people with terminals. So I think that if they are going after a terminal business, it's going to be a lot harder than just saying, hey, we have all these sources of data, come join us, because you're not getting all that other value you get out of Bloomberg. You're certainly not going to be able to charge a similar price to what Bloomberg does, and you've already seen a number of other terminal type businesses that have tried to compete with Bloomberg fail. So I think it's
basically
tough.
Bloomberg is a platform. Not many people would think of Bloomberg as a platform, but yes, the Bloomberg platform would be a communication collaboration platform. You can message, as you're saying, you can build worksheets and collaborate on worksheets and different research across shared workspaces with other people on your team. And so there's definitely a network effect dynamic. There's a lot of deals that get done on Bloomberg. And if you don't have a Bloomberg terminal, you're not in the know, you're not in the network, literally.
There's also the development platform aspect to it. You have a lot of third-party developers building around Bloomberg, similar to what you've seen around Slack and some of these other messaging
and
platforms.
Salesforce, and bringing new data into the Bloomberg ecosystem, selling that data that complements the baseline foundational data in Bloomberg.
Also providing like new functionality and other things for specific trading verticals that the default Bloomberg might not have.
The London Stock Exchange definitely has an investment platform, which Bloomberg does not have.
Right.
But will that be enough on the investment platform side to then really kind of maybe layer in other platforms in addition to this? So, I mean, my takeaway from this is, if Don Robert, the chairman of the LSE, is serious about being a Bloomberg competitor, then this is actually the first of what would probably be at least a couple more acquisitions that maybe bring the collaboration and communication and messaging type platforms.
Something like Symphony might make sense, that would probably be another expensive acquisition.
And why don't you explain what Symphony is?
The Symphony basically was a Bloomberg messaging competitor. It's a communication platform basically launched by finance people for big banks. And I think it's been funded by Goldman and a bunch of these other big banks.
I think it's 20 or 30 different banks.
Internally, and the idea basically is rather than paying thousands of dollars for a Bloomberg terminal when you could get each of the components of that bundle separately, Symphony basically says, all right, just get the messaging component. It's has all the security and regulatory compliance stuff that you need in place. And it's like an order of magnitude cheaper, if not more, than what Bloomberg cost.
Right. Well, and really the genesis for Symphony was that there was articles leaked that Bloomberg was tracking what Goldman traders were trading on and talking about, and they didn't take that too well.
The Bloomberg news side got the terminal side in trouble, which I imagine didn't go over too well at Bloomberg.
No, that's no bueno. Okay, so Weibo. Not many people probably know what Weibo is. Weibo is a social network content platform in China.
It's a lot like Twitter in China. The posts are a little bit longer form than some of the stuff you see on Twitter, but the kind of user interface and use cases are very similar. And
we're starting to see some Chinese platforms, particularly content platforms, make stronger inroads into the U.S.
Yep.
But we'll come back to that later on. But right now, Weibo, Justin Bieber just announced that he joined Weibo. You can see here, for all my fans in China, I just want to say I'm super excited to be on Weibo. Look forward to sharing more. Some good music coming for the Chinese market, and then I guess the Chinese translation of that. Also, now this one was more controversial. So Robert Downey Jr. was promoting this phone, the OnePlus 7 phone, on Weibo. But when you post on Weibo, it says what phone, or I guess, what app on the phone you're using, like from my iPhone and anyway, so it showed that he was posting it from a Huawei phone, which he now blames on his assistant. But I don't know. It's kind of funny. I mean, the irony, A, in just being on the wrong phone to promote the new phone, A, and then B, Huawei is not in a good position with many U.S. companies or people at this point anyway, so it's kind of a double whammy there.
And the Biebs also on the China front was banned from China in 2017, right? So it's a little bit of a bit of a turn for him to be going all in on the Chinese market.
Yeah, he likes Christianity, and I guess China didn't feel too good about that. Okay, moving over to the European part of the world now. The EU clamped down on Android and Google in 2017 for limiting Google search. When you get an Android phone, Google search is the default mode of search on the phone. And they said, hey, that's anti-competitive. You need to open this up. Okay, well, Google has now opened it up. And how did they decide to open it up? They created basically an AdWords version, a marketplace version, to now let you choose between 3 or 4 different search providers. I don't know if I have the list here. I think DuckDuckGo is one of them. And I don't know if Bing is one of them, which DuckDuckGo is basically just kind of, Quant is in here. Anyway, there's 3 or 4 different search competitors to Google, but they need to pay. They need to bid. And now they've created an auction system for these search engines to bid. I would assume based on kind of like priority ranking of where they are in the list, to be considered for the user to click that you want this search engine to be your default search engine. And I don't think the EU is taking too kindly to this. I think they feel like they've kind of been bamboozled by Google. But I mean, I think it's fair. You're letting in the competition. You're letting them bid for how much this is worth to them.
Right.
So you're still opening this up, and I think complying with the essence of what the EU is trying to do. I'm sure both sides are going to belabor the details of it and try and claim that Google is complying and that the EU is saying they're not complying.
But I think Google's point when this whole Android bundling issue came up last year was that, okay, fine, if you're going to take away our ability to basically control this ecosystem in the way that we have been, we're going to have to find other ways to make money.
Right.
And this seems to be one of the solutions to doing that, which is, all right, we're not going to be able to bundle Google Play services and you have competing app stores and search engines. Fine, now we're going to make you pay for it.
Yeah. So, I mean, when you change and hurt the economics of their existing business, then they're going to need to change it. So, but I think they've done a good job of trying to find a right balance while still in keeping with the ethos of letting in more competition. So, let's talk about gambling. So, the Stars Group is actually a Canadian company, platform company in the ETF, but they just struck a deal with Penn National Gaming to enter the U.S. market for online betting and gaming market access. It looks like into up to 20 states that the Penn National Gaming Company is currently operating in. And now they can own, operate, and brand real money online sports betting, poker, and casino offerings in each of these states and bring a lot of the existing infrastructure that they've already built up in other parts of the world into the U.S.
So a little bit about what the Stars Group is and why it's a platform. They own one of the, if not the largest, essentially online peer-to-peer poker platforms out there.
Poker Stars, Full Tilt.
Right.
The list goes on and on and on.
So they're basically the dominant player in that, and most of their revenue comes from basically that part of their business. They have some kind of linear sportsbook type stuff. What I would be interested to see is if they start moving more into more other kinds of peer-to-peer gambling in the U.S. now that this stuff is moving online. Mm-hmm. You've seen some early success with non-gambling, gambling, whatever you want to call it, with fantasy sports and DraftKings and that kind of stuff.
Yeah.
Would be interested to see how they start to move into that stuff as this online gambling stuff becomes more legal.
So Penn National Gaming, they really are a physical gaming company. They have 41 facilities in 19 jurisdictions, 50,000 gaming machines, 1,300 table games, 8,800 hotel rooms, right? So think of them as a traditional casino and racing facility manager. But it says they have some online presence, but it's really not substantive compared to that of the Stars Group, right?
So what Stars is really getting from this is the licenses, which are going to allow them to then operate their online sites and platforms in these
probably
states.
Give some kind of a rev share back to Penn National, but now Penn National doesn't need to invest in all of the infrastructure and technology and ecosystem. There's a lot of people still playing free peer-to-peer gambling on Poker Stars and Full Tilt that are in the U.S., but just haven't been able to actually gamble real money. So Stars Group can actually pay much more than, say, another rival that would want to come into the US because they already have such a strong install base.
Right.
To expand on what you were saying before, I think the interesting thing that we see in peer-to-peer gambling is kind of how can you eliminate the role of a bookie? And if I'm betting on a game, you've got a spread. But if I want, and the spread needs to cover both, scenario A and scenario B. So, but if you actually were to kind of bet straight up with your friend, then if you think about the margin that you are providing to the bookie, you can now actually shrink that margin a lot, right? If you can find someone that you say, hey, I want to bet on the Patriots. The other person says, I want to take the Cowboys. And now you are essentially betting with each other. That's the challenge with the traditional linear betting model today is it's always the house.
And why does this not work in an offline environment? I think the simple reason is you don't have enough scale. You don't have enough liquidity in a physical location. When you go to a sports bookie to say, all right, I'm going to take all these different bets and I'm going to match you up directly. But in an online environment, that becomes much easier to do, and you can actually start to create a liquid marketplace essentially for peer-to-peer betting and gambling. You can have all different kinds of bets that you wouldn't get from a typical bookie, as well as the kind of traditional ones. And the way you make up for that lower margin per transaction is you're going to have a whole lot more transactions in an online environment.
Exactly. And there's a winner-take-all dynamic there, right? If you have the most demand and supply of people coming to make and take these peer-to-peer bets, then you're just gonna, if you are wanting to do a peer-to-peer bet, you're just gonna go where there's the most liquidity.
Right. And for the platform, it's also a much more capital light business model than the bookie. So
if you're not using your balance sheet,
right, and if you get the odds wrong, there's no big hit that comes if some big payouts have to go through, because you're not providing the payouts. You're really just acting as the middleman.
Exactly. So there are some startups doing this. And I think it's inevitable that the industry eventually gets to this point. It's really just a question of who does it and who does it at scale, I think, to again, solve that chicken or egg problem and solve the liquidity problem. So another news, another day, another lawsuit. eBay is suing 3 Amazon managers for allegedly poaching its sellers. Basically, Amazon managers incentivize sales reps to engage in racketeering by giving them recruitment quotes and expecting them to satisfy large chunks of those quotas by targeting and illegally recruiting eBay sellers. So they're trying to, but basically what they're getting at, this is what happened to
Lyft and Uber.
To Lyft and Uber.
Yep.
What's the other example I'm thinking of? Airbnb to Craigslist.
Yep.
This is a common thing where you go into another competitive ecosystem and try and take their demand or their supply and siphon that off.
Typically, it's the supply, because that's often the more constrained side, particularly in these kinds of services marketplaces. So it's not uncommon, or product marketplaces in this case, where you go in, the sellers are the ones that are typically the harder to acquire than, say, the customer. Customers are going to go where the inventory is at the end of the day, and the best prices and availability are. So if they're competing for, let's increase the size of my ecosystem, you're going to go to the sellers. Problem is, there's only so many sellers out there. It's harder to go and create a new seller and get someone to sign up versus saying, here's already this existing supply, I'm just going to go take it.
Yep.
You've seen this happen Uber and Lyft. Now you're seeing it happen with Amazon, and sometimes, given the competitive pressures there, people can play dirty.
Yeah. So it'd be interesting to see where this one goes out. Kind of seems like they're actually going after the individuals. I'm sure Amazon's involved. Amazon would cover them, but these are, I guess, more senior individuals at Amazon, which is why this suit is particularly interesting. So the last area of discussion here is kind of digital advertising, right? So historically, Facebook and Google have controlled just absolutely the lion's share of
about
digital
70%,
advertising.
I believe
70% in the US, and we've spoken about how GDPR actually increased Facebook and Google's dominance in digital advertising in Europe.
Yep.
Because of all the rules and
took out a lot of the small competition,
right? That became just more arduous for smaller competitors to comply with. Now I think just in this past earnings season, over the past couple of weeks, we've seen Pinterest beat on their earnings call. We've seen Twitter post strong revenue growth. Snap has also been, I think maybe has probably at least 2x or maybe close to 3x the value of their stock in like the past 6 to 9 months, largely because they've been able to grow revenue sometimes beating, but also cut costs.
And they also showed some user growth for the first time in a while this quarter.
Mm-hmm. Now, that said, the revenue of Facebook and Google, there's still a very wide gap between them and a Twitter. And actually, now I forgot to mention Amazon. Amazon's actually the number 3 digital advertiser. Now, here's what I find interesting with all of this. The large linear media conglomerates for a long time have talked about how, and here's an article from Hearst, actually. So Hearst is building a self-serve platform that enables Facebook-style ad buying. This literally came out last week. Here's the problem. These linear media companies will never have enough throughput. They will never have enough, essentially, demand and supply, however you want to quantify it, right? I mean, they're not going to have enough supply to then attract enough eyeballs to then be able to fill in enough ad slots.
They don't have the network that these platforms do. This is exactly what I wrote an op-ed for the FT about a year ago now, which was basically saying you have all these traditional companies that see the scale and success of these platform companies, and they basically try to superficially copy that without having to do the hard thing, which is actually transform your business model and become a platform. So,
and what does the platform do? It gives you that scale. It gives you that engagement. It gives you that
Their
supply.
shortcut is, okay, let's go make some big acquisitions, get more supply so we can be, compete with the Google or Facebook. You're never going to do it operating in linear fashion. It's just not possible. You need that third-party network of content creators to do it. And then now the thing here is we have a, quote, Facebook-style, self-service ad. So, hey, we look like Facebook. Of course it's going to succeed. Well, you don't have the actual underlying, data and users and stuff that's actually going to attract advertisers to come there, regardless of what the tool looks like.
Right. So, these linear companies... And the thing is that they can only create so much content that literally the people on their payroll can create.
Why is that? It's because the unit economics of creating content, there's very little economies of scale in creating content. We talked about this with Netflix too. And two, it's expensive. So you can only create so much for your given size of audience, whereas a lot of that problem goes away. You shift out basically the cost curve in a significant way by going to a platform approach, where the unit economics of creating content are very different because that's created by third parties, not people that sit on your balance sheet or on your payroll.
So I think, it is. So I think the linear players in the digital advertising arena and these kinds of tools are honestly futile. They're just not going to make a dent. Even the AT&Ts, even I know Verizon and Oath tried to do this.
Right. They tried to do it. And it didn't work. And now Oath's being basically spun off and sold off because they couldn't get enough scale, and the unit economics of it didn't work. You need more scale. And even if you compare them to a Pinterest or a Twitter, I would put much more confidence in, Twitter's already done it and Snapchat's already doing it. They're building out their own advertising audiences that are material, that are investing. And even though Twitter's ad revenue was $727 million this past quarter, right? Versus Facebook and Google at 16 and 32 billion respectively. Right. There's still a massive gap there, but when you just look at the growth, right? So that was 21% year over year growth for Twitter. Pinterest was at 388 million, 48% growth, right? It's huge growth. And you, as an advertiser, you want to invest in that audience and that community. You're seeing a lot of engagement. You're seeing a lot of interesting digital tools because these companies are inherently digital. And I do think, as we were talking about with marketplaces, there are opportunities to own a niche of a content platform, to own, short form text message content on Twitter, to own the pinning and kind of the photo collage kind of content platform. Niche user groups, niche use cases that say a Facebook does not serve well as the kind of big generalist in the room. Yep. And Google, with search, there's other use cases out there than the kind of major ones that dominate that still can be successful enough and create a niche network to be successful. Exactly as you're saying, it's just like marketplaces where you've got, Etsy and a Goat and a StockX and these sort of niche areas that an Amazon doesn't deliver.
Now, here's the difference between those niche platform players and the linear players is each one of those niche platform players, they're not all competing against each other. There might be some overlap here or there, but they pretty much own their niche, right? Pinterest owns its niche, Twitter, Snapchat. There's overlap between a Snapchat and Instagram, but when you really look at the demos and the engagement style, the engagement style on Snapchat is completely different than that on Instagram, even with just how you can search and discovery and all these things. So anyway, when you look at who the linear players, the linear players are literally all competing with each other. The AT&Ts and the Comcasts and the Netflixes and now the Disneys and the Hulus. They are all splitting the same pie, whereas at least the still niche content platform players at least are pretty much owning the entire vertical that they're in.
Well, why is that? Because they're creating these networks of unique content and unique content creators that gives them something defensible, whereas just general content production, written content or video content there's
no supply side network effect. Right. There's no moat. There's no loop. I've seen a lot of loops on Twitter recently. It's just not there. And it's really just a race to the bottom in terms of saying who's going to spend more money to get more supply, get a bigger supply chain of content, get some hits, get some big show hits and these kinds of things. And that's what determines the outcome of if you have a successful, maybe quarter or two or fiscal year.
Right.
But again, long term, you're still all in the same rat race.
It's a low margin business and it's going to be hard to make money for any of them.
Yeah, but good for the producers. At the end of the day, when platforms compete, when when all these people are competing over the producers, the content creators are net a winner. So it's a good time to be in the content creation business. There's a lot of competition for that supply of content.
There's a lot of money and an increasing amount of money chasing the same pool of talent, basically.
Just ironically, none of the linear media companies actually trying to compete for the user-generated content creators, which they could do very successfully if they would actually try. The funny thing and the unfortunate thing is they're not even trying. So we'll leave you with that today on Winner Take All. Thanks for joining us, and we'll talk to you tomorrow.